we're going to talk about financial reporting for the aerospace and defense industry. And we're going to review the common financial statements that A&D companies use to report on the performance of their business over a period of time. And one way to think about financial statements is that they're really nothing more than a mirror reflecting what's going on in the operations of the company and giving you a look inside of the company. The income statement, balance sheet, the cash flow statement are just different lenses to look at the company. And they're part of the story that's being told about the company. Because finance is the common language of business and the language that we use to tell the story of a company. And who are we telling that story to? Well, we're telling the story to a lot of stakeholders in a business who are going to look at the financial statements. And here are just a few. Within a company, owners want to know if they should stick with it or put their money somewhere else. Managers want to know if what they're doing is helping the company make money and perform. Outside the company, suppliers and lenders want to know if they should do business with you. Customers want to do business with a good, solid company that they can trust to be there for the long haul. So financial reporting is about communication. And our specific objectives in this discussion are to review how an A&D company makes money and how they demonstrate that to the various stakeholders that we just talked about. And we'll cover the three key financial statements: the income statement, the balance sheet, and the statement of cash flows. And we'll also talk about how cash is not always the same as profit. And let's start by talking about cash and what it tells you and what it doesn't tell you. So let's say that you have a company, and as you run it over a period of time, cash flows in and cash flows out of the company. You issued some stock, you sold some product, you borrowed money from a bank, and some cash came in from those activities. And let's say that in the same period, you also paid salaries, you bought a new plant so you could have more capacity, and cash went out from those activities, such that your net cash inflow and outflow, the net in that period, was a negative $53,000. That sounds bad because it's negative, right? Or is it actually bad? What if you had started with $10 million in cash and it went down $53,000? That doesn't sound so bad, does it? But what if you started with $60,000? That's a different story and a different feeling. And what about the assets that you own or the money that you might owe to somebody, to a bank or a lender? But just looking at cash flows, important though those are, it wouldn't have told you about those specific things. So to understand the details, we also need to look at the balance sheet. And what about profit? Are all these cash flows that we just talked about impacting profit? We need more information. We need the income statement. Interest, as an example, is an expense that impacts profit, but dividends are not an expense, even though they're an outgoing cash flow in a given period. So to really understand the story being told about the company, we need more than just cash flows. We need the other financial statements to complete the picture. There are three main financial statements, and we'll talk in more detail about the income statement and the balance sheet. But at the highest level, the income statement compares revenue and expenses over a defined period of time. And the balance sheet shows what the company has in assets at a point in time and who owns the assets, which means what are the liabilities and the equity that you have in the company. The cash statement gives details about cash inflows and outflows, as we just talked about, for the company over a period of time. And actually, the cash flow statement is not even a separate statement, really. It's the worksheet they had to do to come up with the cash line item that we're going to see on the balance sheet.